Welcome to the midweek update, the watch list video with Invest with Rules. It's Scott Bennett and the great Mike Olafson. It's October 29th. We have a very great show for you. We have a lot of watch list tickers as this market has been red hot. Let's dive in. Before we do, Mike, what encouraged you to add this quote? Tell me a little bit about it as I share my screen.
Yeah, well, hello everybody. Welcome to Wednesday here. And for Watch This Wednesday, we sometimes like to insert different topics, things relevant to what's going on in the market. This quote hit me when I was reading an article yesterday that really sums up what I think is going on with the market. And I'm going to read it. In fact, for those of you who are walking your dog or driving along and listening to this, not watching it, I'm going to read it. So, the further you get away from a bear market, the greater the number of people who have convinced themselves they can handle the downside. In the interim, if the indices are performing well, then you could bet that many investors are going to feel pressure to do whatever they can to ride the bull. This is from a guy, Stephen Romick, a longtime fund manager out in the West Coast, First Pacific Advisors, very successful over the years. And to me, this quote sums up really fear and greed, or fear and FOMO, whatever you want to call it, of what's going on in the market and what possibly can explain what's happened with this V-shaped recovery coming out of April. And the market keeps defying popular belief. Like, why does it keep going up? People are afraid, etc. This sums it up. So I'm going to break it down just super quick and then flip it to you, Scott, for your comments. The first part of it is talks about Stephen's talking about the fact that people start convincing themselves when the market is really frothy, they can handle downside risk. I think people are already forgetting what happened in March and April when the market was down 15, 20%. I think that's already a distant memory. But then the second part of it kind of ties into what I think has happened with the market, where you've got people that are afraid of missing out. They're kind of forgetting the risk. They're afraid of missing out, and they want to jump in the market and start deploying capital. So I think you still, even now in October, late October, I think you still have fresh money coming into the market that's afraid of missing out on this continued uptrend. Scott, what do you think?
I'll give two short anecdotes. My wife came home yesterday with two stories for me. Number one was someone that she used to work with that has a position in an AI company, and she was discussing how well it's done. Obviously, I mean, my guttural reaction is they're probably way oversized in the position. And then the second anecdote was one of the fathers at school was sharing how much money he's made in the cryptocurrency Ethereum. So these are the types of stories that come from an eventual bubble. And it's okay to ride the bubble, but it's also great to have a process to not get steamrolled because what did it take for Qualcomm to come back after the dot-com bust? It takes an awful long time, and there's an awful large amount of torture that comes from a situation like this.
Yeah.
So we're in it too. So before we jump in, world's quickest disclosure. This is just information. It's not a direct solicitation to go buy or sell anything. Please always manage your risk, manage your plan. We care about you greatly. You know the dance. And the market's a 10 out of 10. So when we look at the trend of the US foreign, we look at small caps, we look at the major trends of the market, everything is kind of full steam ahead. We've been picking up our exposure, but 10 out of 10. We're watching our portfolio heat, and you can kind of see how if you go back to last week's video, we drew a wedge pattern. We broke out, we tested it, and now you're up and out. And the market is now on an overheat. So it's a short-term and long-term uptrend. This is as good as it gets. And then we have a mechanism to say, hey, we already have a full position in SPMO, the momentum version of the S&P 500. We have a full position in the Qs. We have a full position international. The small caps haven't really participated this last week like the large cap techs have, but we've added mags and we've added semiconductors and we've added more large cap growth exposure because we want to participate. That's the reality of it. But we're going to do so with managed risk. Mike, when you see this chart, stock market score, what sticks out to you?
Well, what sticks out is the overheat. We're going to see, in fact, as we take a look at the next few slides, we're going to see a lot of overheats. And so going back to that quote from a couple of minutes ago, from that the mutual fund manager, please be careful. If you got a lot of money in the sidelines and you're starting to deploy it, please be careful because the overheats are just our way of mathematically saying, hey, things are extended, and you can see it right on the chart. So just, that to answer your question, Scott, that's really what's jumping out of me.
Yeah, and overheat is still in this green zone in an uptrend, stage two. The short-term trend, roughly 30 days, the long-term trend, roughly a year. But we mathematically say the relative strength index is over 68. You're approaching 70. It could get way higher, and that's totally fine.
Yep.
But
Yep.
what's also not normal is picking up a stock yesterday and having it go up 6% today. That's not totally normal, and we love it, but it's not normal. So this is the market health gauge. It's a busy slide, but off to the right, we're looking at strength over the roughly last 2 weeks, and then left is weakness. So before I get down there, you can see our exposure, you can see our beta, you can see our heat. So if everything hit our trailing stops, give or take gap ups and gap downs. So there's more overheats coming, is what it looks like. But the very first thing is there's a bunch of green, and green is great. So you now have healthcare, and then you have the tech, international, and S&P 500 all doing quite well. Pulling back, you have utilities, gold, small caps, industrials, even though like Caterpillar on our billion-dollar rank is up like over double digits after earnings reaction. It's incredible. We have a position in XLI. We minimized our position in gold. It was an amazing run. We just still have some exposure. And then what's not participating is real estate and staples, and financials are trying to get it together, but they're not really participating. Mike, anything stand out to you? This is a really interesting week where you have a lot of mega cap tech earnings, and you
Yep.
can see, I'm not sure why it went not red, but NVIDIA, Google, Microsoft, Apple. There's a lot of overheats here, but a lot of green. Tell me what do you notice at the bottom of the mega caps as earnings are coming?
Well, no, I think you kind of summed it up. I'm seeing on the right-hand side the overheats. On the left-hand side, I'm seeing kind of what mirrors the strength gauge of the sectors, financials, et cetera. And I guess the other thing I do note here is you've got several sectors that continue to try to bounce off the left-hand side but seem to get knocked back. Like XLRE and XLE energy are two examples. So interesting what's going on. And I think, rotation is happening, but it's a lot more subtle than I think anybody would give it credit for.
Yeah, so let's keep rolling. So our process is we follow big money. We want to know what these billion-dollar funds are accumulating. We're going to follow the trend. Sometimes they get it right, sometimes they get it wrong. And then very simply, we're looking for earnings growth. Very simply, it's not that simply. We look for earnings growth. We look for fund buying. We look for volatility adjusted momentum. And we put it into a package that shares what we're after. And I'm going to share with you the top 10 from our list every day before our trading window, which is 2 p.m. East Coast time. We reshuffle the deck based upon our multi-time frame momentum model. So we have our cut monthly, and then every single day this list has the ability to change. So you can see how, as an example, Advanced Micro Devices, AMD, started the month, as the month is almost over, at 49. Today it's 2. It has had a remarkable month. 66% for the month. Incredible, right? So you'll see some of the tickers that we have exposure on at the moment, Snow, Celsius, Corning doing super. But you notice that there's a bunch of overheats. So put that into perspective. And you have a lot of blue, meaning there's a lot of earnings right now. So that could go in either direction. So a lot of gas signals, and we're watching this closely. I'm going to pivot to the ETFs. So our members, this is always available to you, the entire list in the members area. If anyone's interested in this, just let us know. hello@investwithrules.com. But here's the ETF rank as well. So multi-time frame momentum model, and then we're going off our signals. So you can see semiconductors. It's been red hot. We added a new ticker. So semiconductors, there's different versions, but this one is a little different. Coin shares, Bitcoin mining. This is the hottest part of the market right now. I mean, an ETF up 172%. It's pretty wild. So we're going to observe it. We have to bear in mind at the end of the day, does it fit our risk parameters?
Yep.
Aerospace and defense, international, Mag 7, QQQ, quantum. We'll look at that later. So these are some of the hottest ETFs. We rank them. We're looking at the gas signals. And then very simply, we whittle the stock in the ETF list. And that brings us to our watch list. Mike, what do you notice here? Or what would you like to share before we jump into the charts?
I say we go ahead and jump right in. I think the watch list represents what we've been talking about the past several minutes. So let's just start getting into some charts.
Cool. We're going to do top 10 gas signals based on rank, top 10 ETFs based on rank, and any new signals today. Mike, what do you notice about the Broadcom, AVGO? What stands out to you?
Well, clearly, well, first of all, this is a market surge chart. And what we're looking at here, the blue zone is the market surge buy zone based on a cup with handle base. And you can kind of see that a cup with handle shown in the green lines. And clearly Broadcom is breaking out. We got let's call it a cheat signal. So we got a new gas signal, an uptrend about 16 days ago, and you could see it was kind of as a cup was forming. And so anybody who did happen to take that, you got a good early cheat. And now you've got the legitimate breakout going on. And it's obviously held the gap up that happened back in September. So what are you seeing, Scott?
Yeah, it's on an overheat. So this the
Yes.
reality of this morning. So it went from gas
Yep.
to overheat, which could easily pull back to a gas or just be run away. So for us, I would expect it could go a lot higher, but I would expect a little bit of a check back before it makes another run higher. But again, great earnings, great sales. This is exactly where you want to be in the tech space with NVIDIA and its friends. We're going to go to a stock that maybe most people are not thinking about, but the fund managers are here. So Dollar Tree, DLTR. You have a short-term and long-term uptrend, number 19 on our rank as of this morning. You have a more recent signal, 15 calendar days ago, up 7%. This is kind of one of those things where inflation is slowly, like it's benign, but it's coming back, and we all know it's coming back. And what do people do is they change their spending habits. So when you look at the inflation reports, they'll say, okay, if beef prices are high, more people will eat chicken. It's kind of a bizarre way to say it offsets some of that inflation. But what people do is they go to a Dollar Tree to pick up Band-Aids versus go to CVS. And they do these trade-offs. But you'll notice that it went from 61 bucks to $118. And then it had about a 50% retracement. And now it's coming back. So that's something that will be on our attention. And the retail customer is not gone. They're just changing habits as inflation is slowly becoming more and more obnoxious. So number 19 is Dollar Tree. We're going back to tech. TSM, Taiwan Semi. Mike, what do you notice here?
Well, hey, Scott, if you don't mind, go back to Dollar Tree real quick. Just want to get your take. We talk about gap ups a lot, and we don't talk about gap downs quite as much because we don't see them quite as much. In this case, you've got Dollar Tree coming back up to that gap. What's your take on that? I'm curious as to what you're seeing here.
There's people who study gap fills,
Yeah.
meaning there's a lot of times where whether it's an algorithm or memory, but I would not be shocked if this gets right up to 107, fills the gap, and then pauses, and
Okay.
then it's gonna then you go back to focusing more on earnings. So gap fills happen. They happen like 99.9% of the time on things like the VIX or volatility in major indexes. So there's a lot of muscle memory on gap ups gets filled, gap downs can get filled. So I think that's important to note where those are.
Cool. Thanks. Appreciate it. All right. Yeah. So let's talk about Taiwan Semi. Clearly, the semiconductor space has been red hot since the April lows of Liberation Day and that all that kind of stuff, that time frame. And Taiwan Semi is no different. You've got on gas uptrend lined on long term, short term. The gas signal, the latest one hit on September 4th, coming out of that consolidation. So the market surge chart actually shows it nicely. There was a bit of a consolidation, and then you hit that blue buy zone. We got the gas signal off to the races close to 30% later. Now, it's also the other thing of note is that green line is the 21-day EMA that market surge shows standard. And Taiwan Semi's done a nice job of kind of bouncing off of that a couple of times, closing above it or at it. And now it's in that green take profit area. But as trend followers, what I'd be doing if you're in this is managing risk, of course. You absolutely have to. But then preparing for this thing to burst above, hopefully, that 311 recent high. What are you saying?
Manage your risk, but this is a stay long, be long, is what it looks like to me.
Yeah, there you go. I like it.
GE Aerospace. So General Electric spun off into three units. They have their aerospace, they have their healthcare, they have their kind of clean energy. And GE has been rocking. I mean, it really is. And it's double-digit earnings. It has really nice sales. Short-term, long-term uptrend number 35 on our list. You're seeing the ITA ETF or the Industrials ETF. This is kind of the core position, and you've been consolidating since September, and it looks like you want to break out again. You got your signals all the way back in April, and it's been a great ride. And this is again an area where the funds are still accumulating, number 35. Another stay long, be long. Looks interesting. Any thoughts there?
Yeah, I think you nailed it.
Why don't you cover Goldman?
All right, Goldman Sachs, obviously, in the big bank space, it's on a clear gas signal that is actually 5 days. We're in day 6 of the latest gas signal. And this kind of goes back to what we talked about a couple of tickers ago, where we're in this consolidation base and market surge is identifying it with those green lines. We're kind of in the middle of it, trying to working up towards the upper end of it. And the key is our signal gave you that early entry, or as Minervini calls it, that early cheat, that possibly to get into it at the lower part of that base. Now the expectation is you'll get some momentum out of it, and you'll be in some profit before you hit that blue buy zone. So one method of this, if you're in it, could be you hold it to the blue buy zone and then fill out your position when it hits the true traditional breakout. Scott, what are you saying?
Yeah, I assume this was an earnings reaction, which was positive, and we got our short term, it went from a coast to a gas at that moment. So we're in an environment where money is cheap and getting cheaper as the Fed is likely to lower rates later today, as expected. And this encourages more IPOs and more companies becoming public versus private. And you need a partner in this game. And Goldman is one of those people who will greatly profit from that activity, plus trading, plus everything else that they do. And that's why you have double-digit earnings on Goldman.
Yeah, what's kind of interesting is the earnings were back about a week before that really nice bar. So clearly there was some digestion of earnings, and obviously what's going on in the macro, economic space. And there you go, you got Goldman working up that base.
Yeah. And again, for members, this is something where if we always share what our trailing stops are, but if you have questions, we're here for you. We can make more videos. We have lots in the FAQ section and our videos in the members area as well. But we're going to move over to ETFs now. So VEU, full disclosure, we have a full position. This is all world minus US. So despite what's going on in the US, it's going overseas as well. And it's just been, you can kind of see it's just minus this one gap down day, which pretty much held a double bottom. That's been higher highs and higher lows, and you've just been drifting higher, whether it's Japan or Europe or many different economies are doing extraordinarily well. So 1014, you got your kind of your initial, that's up 3%, and then it's been going since April. A short-term, long-term uptrend. International deserves some attention. It is outperforming the US year to date, which most people don't think about, but it's a rarity, but it's happening. I'll pivot to the next one, Mike. What do you think about telecom, XTL,
So
in the telecom space?
Yep, yeah. XTL is a relatively recent addition to our ETF list. We follow a bit over 80 ETFs, and every hour, every day, trading day, we're reanalyzing this list. XTL came from a member suggestion. We do our monthly ticker submissions where we have a great time going through all the member tickers that they want us to take a look at. XTL came out of one about 2 months ago, and look at how this thing is run. It's on a gas signal. It actually the latest gas kind of came within a day of each other back in the end of April, and it's been off to the races ever since with about a 60% gain. Pretty astounding. The other thing I'll note is I'd say the first area over the last few months of, let's call it, problems or pullback has occurred the past 2 weeks. But just like the market, it's worked its way up out of that, and it's now trying to make all-time highs. It might be by a couple of pennies. It's hard to see in the market search chart. But at this point, if you're in this, doing nothing wrong, manage your risk. If you're not, then just please be careful. It's definitely up there. What do you think?
Yeah, I mean the red line from market surge is the 50-day simple
Yep.
moving average, and whenever it gets a little too extended, it seems to pull back, and it gets a little too extended and it pulls back. And it just did it. So could this go higher? It really depends on earnings, but that looks still very appealing. It's on our
Yeah.
watch list. And this is so I just want to share how if you're not an ETF person, that maybe you should consider it. Because if you think about individual stocks, specifically in the quantum space, where a lot of them don't have earnings, so it's maybe the next generation of where these GPUs are going. This is volatile stuff. So if you're in an ETF, it diversifies you out over multiple companies. There's like IonQ and Rigetti, and there's a ton of them. And versus one, and all it takes is one to ruin your whole week and your whole year of profits. So I mean, just think about it, 60%. That's way better than the S&P year to date. So since the buy signals. But the buy signal came 2 days after the low, 58% in quantum, QTUM. These are super like volatile tech stocks. So you can kind of see how it broke out of a flat base. And then you got on 822, you got another signal. The short term went back to positive. And lo and behold, it's been just doing extraordinarily well still. So I would say that this is an area where a basket of stocks that are volatile can still be volatile, but not as dangerous as an individual ticker of a company that doesn't make any money. So that's quantum. It's on our radar. It just looked like it just had a nice consolidation, tested this gap down day, and off it goes. So there goes another one. And then Mike, why don't you finish us up with SPMO?
All right, so SPMO, for our longer term members, you'll recall that we went into this instead of the S&P 500 because back coming out of the April lows, SPMO triggered a gas signal earlier than the SPY, the S&P 500 did. And what is SPMO? Just as a quick little refresher, what they do is every 6 months they take the top 20% of the S&P 500, and that's what this ETF is comprised of. So it's all about momentum. And so they're taking the top 20%, and for the next 6 months, they ride with that. Is it perfect? Absolutely not. But clearly, the results are showing that it's been beating the market handily. Since that April 24th gas signal, up 34%. And with this most recent consolidation, it's had just a nice orderly. In fact, I'd argue, Scott, that the past, let's call it, say, 3 weeks, have been more orderly than the market overall. And it's behaved, I think, a bit better when you think to be more volatile action or something like this. But bottom line is, it's now making new highs.
Yeah, I would just set an alert at the 50-day simple moving average and enjoy the ride. We'll
Yep.
finish off with, I think, Japan is our last one, I think. EWJ. Obviously, they're doing a lot of stimulus over there. Short-term, long-term uptrend. 14 days ago, it's up just a 2%, but it's at the end of April, you got your 20% run. This is this is what an uptrend looks like. So EWJ doing nothing wrong. Whether you like all world or you want to get really specific, this is working. This is working quite well. And we're going to move over to two signal changes. So when you get a coast to a gas or an overheat to a gas, just a new gas or a new U-turn, we have American Express double-digit earnings, short-term, long-term uptrend, number 40 on our billion-dollar fund manager rank. You can kind of see how it had a big cup and handle, worked until it didn't, another cup, and then now you're kind of working its way on this market surge chart. But you got some really big volume more recently on, I assume, some version of an earnings reaction. So 1017, it's up 4%. This, if you're trying to figure out where is the hottest part of the financial space, we showed you Goldman, we showed you American Express. This is what the funds are after. Mike, any thoughts on Amex?
Yeah, it looks like, yeah. In fact, it had earnings similar to Goldman. So I think you had the same type of deal, some digestion of what's going on, the economy, and there you go. It's now working very well.
All right, last but not least, Freeport McMoran. We're going to exploration, digging out gold, copper, silver. We're all over the world doing this. So the number 69 on our billion-dollar fund manager rank. So it's had a clunker of a year. As you see, its earnings were actually backwards, a negative 1% earnings growth. But next year, 44% projected estimate earnings growth. Short-term uptrend is today. If it closes, would be day one. You can kind of see the double bottom forming. So you shook out people from over here. And lo and behold, if you were to draw a trend line, the purpose of these new signal changes is to help you see, to focus your time is really what we're trying to do for ourselves. So whether you wanted a cheat, today's your cheat day. If you like buying over the second tranche of the double bottom, there is your buy entry from Market Surge. It's been 22 days of a long-term trend. This is something that has not worked, but very likely could work. Obviously, managing risk. It had a nasty gap down. I think it was copper, and it had a kind of a problem with one of their mines, is from my understanding. And you filled the gap, and now you've consolidated after you filled the gap here in October. So one for the watch list. That's pretty interesting. Mike, thoughts on FCX?
Yeah, if somebody were so inclined to do an FCX trade, the risk is pretty obvious. It's either the low of last week or the 200-day, which looked to be almost exactly the same. Obviously, the algos, it's too obvious actually. So, make sure you kind of maybe give yourself a little bit of room below that, a little bit of buffer so you don't get shaken out. But it looks like a pretty good risk reward setup. One thing I just want to mention, going back to earnings, is our billion-dollar fund manager list. One of the criteria is we're looking for earnings growth. We want to see about 10% or greater, and clearly FCX fits that bill.
And this is a little bit of a spillover. So you've had an amazing run in gold. You've had a really impressive run in silver. And this could easily keep going. Because if you think about it, if you're a sovereign nation, a government, do you want to be owning tons of treasuries, or do you want to own gold, or do you want to own something else, Bitcoin, stocks? And they're making that tough call. And so what happens is the precious metals spill over. So whether it's platinum, palladium, copper, this is a play on copper. So, and a play on the metals, and this is someone doing it with leverage. So I hope that's helpful with a kind of our overall thesis for you. So first, for members, thank you for being a member of Invest with Rules. We greatly appreciate you. Our philosophy works. Just some years it's amazing. And some years when the market's getting clobbered, we have a plan. So follow the trend, follow big money, follow risk management rules. If you have any questions, reach out to us. hello@investwithrules.com. If you're going to pick up your child, or you're talking to your family and the topic of the market's coming up and they're not an Invest with Rules member, just go to investwithrules.com. Have them at least get our free S&P 500 ticker tool. Stay on the right side of the trend. Please don't let them get smashed when this pops at some point down the road. And if you're like, this is amazing, I just have no time. I can't pull the trigger. Something strange is going on where I can't either buy it, I can't sell it. I need a little bit of guidance. Reach out to us. hello@IWR Advisors. It's a totally separate business with a similar philosophy and structure for research. So again, Mike, final words on this midweek watch list video.
Yeah, thanks for being a member. And going back to that quote from the very beginning, as long as you have a great process, don't be afraid to follow your process. And likewise, don't get caught up in greed and FOMO. So follow your process, avoid that emotion, and you should end up being a pretty darn good shape. We'll talk to you on Friday.
All right. Trade well. Enjoy your day. I hope this helped you identify some uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com.